That's what I was when I left my last job almost 10 years ago and went out to buy a small company, and I've now done that a few times and been super fortunate, had a lot of fun, and now I'm trying to hopefully teach everybody else who's trying to be on that same journey how to do the same thing.
Love it. I think a big key note to point out there is that you actually do this stuff. This is not an identified opportunity that you had, but more of, hey, you're the best in the business at this, and you're trying to help other people out in the journey. So that's awesome. So without further ado, Sam, you want to pull up those slides, just that green share button down below us here, and we can get rocking.
Yep, let's do this right here. All right, are you seeing my screen, everybody?
Give us a second. I believe it's about to start pulling up. What's it look like on your end?
Model on the left and slides on the right.
Let me see here real quick. Yep, there we go.
Good to go?
Live. There we go.
All right, well, let's get started because this one tends to be a topic that everybody has a lot of questions on. And I'll warn everybody real quick before we get started in this first webinar of what's going to be a 6-part webinar series to finish out the year. Uh, by the way, Peter, who just raised his hand, Chandler's going to moderate the chat. I think we've gotten a few hands raised. He, Chandler's going to moderate and he'll relay questions, and that way we're doing things live here. Chandler, are there any issues before we get started?
No, I think we're ready to go. There might be a bit of a delay, but it's all good on my end. So I think some people are raising their hands because it's going to pop up here soon. But it's a long-winded way of saying we're ready to rock. And this is being recorded as well, so everyone will get a copy of this, and then we'll open it up for some broader Q&A at the very end.
Okay, so let's get started. Let's first start by saying, before we dive into numbers and financial model and some slides on best practices, a couple things to keep in mind. Because everybody who maybe is a little bit unfamiliar with financial modeling or buying a small business in general, they might think that the answers are found to the answers to their SMB acquisition are found in a model. And I think the most important thing to clarify is that the model is just a tool. A model is a tool that we use at, call it, various stages in the deal process to help us gut check how we're analyzing and thinking about the acquisition. So, I think a lot of us have heard this phrase, garbage in is garbage out. The model is just a tool that, if given inaccurate or poorly assumed assumptions, is going to give you bad information out. And so the hardest part about a model is not what numbers to put in, it's how to think about the numbers that you're entering into the financial model. And secondarily, I think a lot of folks forget when to use this. So a financial model is a tool you use once you have done the early stage things of signing an NDA. Remember, you get a teaser from your business broker. You go sign an NDA if it looks like it meets your criteria. And then right after you sign the NDA, you're going to get what's called a SIM or a SIP. It's a 10 to 50 page summary of the acquisition. And it's in that booklet of information in the financials that'll give you some information to get started on your model. And we'll walk through what that might look like using a real example. And then this is where you use this tool, and you use this tool to analyze, potential purchase price, DSCR on your bank loan, which is debt service coverage ratio. It's kind of like the gold standard KPI for SBA lending. And then, for example, I'll scroll over here. You're going to need to smell check, the returns to investors and all sorts of things. So you're going to use this financial model as a tool all the way from when you first receive the financials and the SIM on your acquisition, all the way until maybe even the day you close when you're updating it for the most recent financials and to make sure that your investors are getting the opportunity that they want. I think the biggest takeaway, though, and we'll dive in, is I see a ton of searchers who come through boot camp that spend inordinate amount of time in their model. And they will do this as some sort of academic exercise. And they'll spend a full day or several full days modeling and checking their formulas and really trying to make their model perfection. And unfortunately, I think that time could be better spent elsewhere, diligencing their deal, talking to potential customers, talking to staff, and perfection in the model is impossible. So don't overdo it here. This again is just a tool. So with that, let's dive in. So again, to our point that deals do not get done in an Excel spreadsheet. That's kind of the punchline, which is don't overdo your model. And I think what we're going to do is instead of going through, we're going to hand out this PowerPoint. Instead of going through the components of a model, in a PowerPoint, we're going to take this sheet. And Chandler, I want to make sure you're seeing the whole thing.
Yep.
Do you see the full model now when I do this?
Yeah. Now we're on the slide deck.
Okay, hold on.
There you go.
Perfect. Okay. So this is the summary tab of the model. This is where a lot of your outputs are going to occur. But where we always start with a financial model is what they call sources and uses. And sources and uses is kind of the first thing I always think about when I look at an opportunity to buy a company. And you always start with the uses, right? The uses are what you're going to need cash for, what you're going to need capital to do. You're going to need capital to buy the business. And so what we always want to do is think about what's the cash at closing that you're paying to buy the business? What's the seller note, the deal expenses, and the excess cash you want to put on the balance sheet? The total there is this phrase that SBA lenders will use called project cost. Everybody thinks purchase price. Purchase price is like, for example, the cash at close plus the seller note. In this case, it would be $5 million purchase price. But people forget that there are other things that go into acquiring an SMB. You've got to have expenses that you pay, and then you need to put some cash in your bank account at closing. And the total of all those items is what's called project cost. And you'll see your SBA lenders using that phrase instead of purchase price. And so, obviously, just like a balance sheet, you have these uses of capital and you need to match them with different sources. And so most people know that the SBA loan is going to pay for the majority of the purchase price of the business. In many cases, there's a seller note where the seller will take an IOU instead of being paid cash at closing. And then the balance is in the form of equity. And we break it out in terms of equity that the investors put in and then equity that the searcher puts in, just to differentiate the two. And then I always suggest to have a line of credit at closing. Most lenders will be happy to give you a line of credit, and that's just for a rainy day fund. So you don't actually use any of the line of credit at closing. And so the sources and the uses need to balance out. But before we go too much further, let me just kind of introduce you to some things in the model. First of all, everybody's going to have access to this. It's already out in the public domain anyway. But every item, every number that you see that's in blue is a number that's meant to be hard coded in. It's not a formula. It's meant to be a number you input. And so you're going to see them all over the place. But in large part, the assumptions is where you're going to input some of your basic information from your acquisition. And then anything in orange is a number that's brought in from a different tab. So for example, you see revenue and EBITDA And those numbers are in orange, and it's because they're coming from the second tab called the pro forma P&L, which is what we'll cover next. And then the last thing is over the years, as we've used this tool, what we've realized is that a few inputs really make the lion's share of the impact on the outputs. And so the items I've highlighted in yellow are primarily the items that really make a big impact. Purchase price, size of the seller note, your revenue growth rate, which impacts your pro forma P&L, and then obviously how much equity you put into the business versus debt, and then the gross equity step up that you grant to your equity investors, which impacts how much the investors own versus how much you retain as the searcher.
Can you stop real quick on the step up and what
Sure.
exactly that is?
Sure. Yeah. So when we'll come back to it a little later, but the gross equity step up is another framework that the ETA community has created to assign percentages among the different investors. And so the old-fashioned way of representing who owns what in the business is to say, if I put in 10% of the total equity, which is in this example, $800,000. If I put in 10% of that, which would be $80,000, I only own 10% of the business. You put in 10% of the equity, 10% of the business. And what we found is that that framework, which is sort of the normal framework you learn in school or, if you're investing in the public markets, that doesn't work here because the searcher is doing so much more. What that doesn't do is reward the searcher for all of her or his effort that goes into sourcing the acquisition, doing due diligence, taking the risk involved in the PG on the SBA loan, and then operating the business. So what it doesn't reflect is the sweat equity that the searcher should get for having done all of that work. And so what we've done is we've said, all right, instead of, that old framework, we're going to take a totally different framework, which is if total equity is $800,000, that represents a certain percentage of the project cost. And so we're going to step that percentage up to reward the investors a modest amount for their cash contribution, and the remainder will go to the searcher for their sweat equity. Because the searcher, all of us searchers are doing this to be the principal owner of this small business. And so that framework will allow the searcher to, in most cases, own a majority of the ownership without having to put much, if any, cash into the deal. That's the long-winded answer.
That was beautiful. Thank you.
Okay. Yep. So why don't we move over to the Pro Forma P&L tab? So this is just a Excel spreadsheet of a P&L, and I thought it might be helpful really quick. Chandler, are you seeing this right here?
Sim?
That sim?
Yep. What's up
Okay.
now?
All right, great. So what I wanted to say is some folks will ask, where are you getting all this financial information from? And it's really simple. This is just a sample transaction that we've seen in the past and actually acquired. And so it's really no heavy lift to do as follows. This is a single slide on a sim of an actual brokered transaction. And all we really do is copy and paste the financials that are provided here, as well as the add backs. And we just copy and paste them over into the model, which let me get back to. There we go. So if you can just trust me for a sec that I've tried to do my best, I think the numbers are accurate. Copying and pasting that financial information from the sim into the model. And so that's an older deal. We bought that business with a searcher 3 years ago, 3.5 years ago. But what we do is we paste all that in revenue, cost of goods sold, OpEx, And then we work through a lot of the add backs. Again, the information in blue is the information you have to input, and the information in yellow is the information we found in the past to be really impactful on the outcome of your model. And so this sim, for example, was from a broker that offered a lot of high quality information. They were a high quality broker. And so we were able to rely upon those ad backs as being legit. And then what we further do is then we sort of layer on what are called pro forma adjustments, which just means what impact on the P&L are we going to have after we buy it? Well, the new owner, our searcher, is going to have a salary. There's going to be payroll tax on that salary. And then in a lot of cases, which is why I put it in there as a guide, a lot of cases, searchers find that their rent ends up going up at a closing for a host of reasons. We can cover it another time. So anyway, all this does is it just spits out a certain EBITDA number. And to be clear, I've done something unique here for purposes of our example. I've hard coded in a different pro forma adjusted EBITDA number, which gets brought back into the model. And I'll show you where and why, but I did that just for example purposes. If you're using this model, just simply take this formula, spread it across, and boom, you're all good to go. But it's a better example using clean numbers.
Mhm.
So once you have your P&L all set, what really matters is that your model is going to speak to what the business will look like in the future based on assumptions. So revenue and EBITDA in the future comes from this right here, which is an assumption around revenue growth and an assumption around EBITDA or SDE margin. And so all the time, I'll get a searcher's financial model, and she or he are looking to raise some equity in their acquisition. And they'll show revenue growth rates of 10 or 15% a year. And that's like the first question I ask is that reasonable? And maybe in the last few years, the revenue has grown that fast. But I think most of us investors in the community and the SBA lenders in our community would say that that 10 to 15% revenue projection forever for the next 10 years is too aggressive. And, I think a lot of SMBs right now are having, kind of middling years where maybe revenue is flat. And I don't think it's fair to you, the searcher, to assume your revenue is going to grow 10 to 15% a year. I think kind of flat to 5% is much more reasonable. And having been a searcher and a operator in the past, it's just not as easy as it looks to have double-digit growth. I'd rather be conservative, and the bank and your investors would rather that too. The second thing is the EBITDA margin, which, unfortunately, SMB accounting is not always super clean. And so you might look to the average of the past 3 years and say, hey, on average, they've done something like 16% EBITDA margin. I'm going to keep that growing in the future. And I think that's probably fair. But what I wouldn't do is choose the highest of the last 3 years and assume you're going to expand your EBITDA margin in the future. But
I have a
go
quick
ahead.
note on that. I think it's always best practice to be even projected going down at least, because a lot of folks always talk about the J curve, right? So when we're acquiring these businesses, oftentimes we see opportunities to pull levers, whether that's new hires, that's new systems, softwares, whatever it might be. And where do you think that money comes from? It comes from your bottom line. So if you think you're going to make all these big changes and still maintain the same profit margins, at least for the first 2 years, you might be in for a rude awakening come year one.
Great point. So, and there's a few ways you can do that. And maybe some examples would be, right here, it would be fairly normal to just kind of insert a couple rows and say, everybody loves this one, a new CRM, or another one would be like a new VP of sales, and layer in some of those costs that cause uh, owners to ride the J curve down. The J curve is just sort of like a linear projection of earnings, and they tend to go down in the early years when you are investing. So the other way to do it would obviously be to hard code in a different EBITDA margin, like Chandler said. You would do that up here, which is, whoop, sorry, you would do it just here, and it pulls from E31. So you would just essentially change this number. That's how you'd impact the model. What we've seen a fair bit too is sellers who are looking to retire a lot of times have optimized their business for profitability. They've sort of reached that plateau where they know at $6 million of revenue, they make $1 million of EBITDA. And that is like the highest quality of life trade-off between EBITDA and energy it takes to create it. And so a lot of times what we'll see is searchers will go in, they'll buy a business, they'll get in the shoes of the owner, and they'll say, this is great. I can easily grow the business to $7 million of revenue. That extra million of revenue, not hard to get. What they fail to realize is to get that extra million of revenue, they have to cut their margins way down. And so that's where they'll see some margin J curve. Okay,
Great. Great.
Chandler, just out of sake of time, you want to get back to the model?
Yeah, let's do it.
Okay, so what does the model do? The model is meant to be, and I'm going to start here in rows 13 and 14. The model is meant to be like a visual representation of what happens to the cash flow of your business. First at the top, second, third, and fourth to the various parties, the various partners in your business that have a claim on your cash flow. And so this is all meant to do at the very bottom. It's meant to tell us a few things. One, will the bank approve your deal? Two, will investors want to invest in your deal? And three, will your seller and the assumptions you're making to have your bank and your investors say yes, will those work for the seller? So let's just do a little bit of a quick example all the way through. So again, we're pulling adjusted EBITDA right here in row 14 from the separate P&L tab. And so everybody is quick to say when I ask the question, who's the first party to get your cash? The first party everybody always says is the bank. But that's not true. In fact, there are lenders in our community who have started changing their underwriting simply because we have introduced this concept, which is real. This is what happens in the real world. The first party to take your cash, your EBITDA, is the IRS. So almost all of us will buy a business through an LLC, which is typically taxed as a pass-through. And so you have to make tax distributions. It's a requirement in your operating agreement that says if you are making profit, taxable profit, and all of your owners or the company have to pay tax, that you the company have to either send your partners cash to pay the tax, or you have to pay the tax itself in the case of a C corporation. So we built into the model this quick and dirty calculation of your tax liability, which would either be a tax liability to the IRS or to your partners. But either way, very clear. So we've first claim on cash is to the IRS. So then what's left over after you've paid the IRS is right here. And that's free cash flow to lenders. I should back up and say all of this is formulaic. So if you notice, these are all black texted cells. That's all formulas that are doing the work for you to approximate what your tax liability is. So you don't really need to guess on that. All you have to do again is to fill in all of the cells in blue text. And particularly these two impact your taxable income figure. Okay, that was an aside. So back to what's left after you pay the IRS is your free cash flow to lenders, row 22. And so what are we going to do next? We're going to go and we're going to speak to our bank. Maybe our bank has given us a term sheet if we're already under LOI, or maybe we're just having an early conversation with our banker and they're telling us a few things. But what we know for sure is that the SBA loan is a 10-year covenant-free straight line amortization product. And so in our example here, remember the beginning balance of our bank loan is just pulling from up here. Black cell means it's a formula. And that bank loan size is just a reflection of how much equity and seller debt you have. So it's all formulaic for you. So what we're going to do is we're going to pay that loan back over 10 years of principal and interest every year until it's paid off at 10 years. And so all of the amortization is done for you in this cell. No need to go mess with it or hard code anything. All you have to do is input your senior term loan interest rate, and everybody should be on a 10-year term. There are exceptions. It's a small exception when you buy real estate, but let's ignore that for now. And everything else will populate itself. And so as you can see, in year one, for example, on a $5 million purchase price business, where $3 million of bank loan are used in the acquisition, which is 57% of the purchase price, 57% of the project cost is coming from a bank loan at 11.5% interest rate. That first year, down here in the bottom right, the sum is $506,000 are going to go to principal and interest. And so obviously that's a huge concern. That is the primary taker of your cash is the bank. And it's pretty stressful because, it doesn't come out once a year. It comes out every month automatically. And so you need to have a buffer of cash to be able to make that payment every month. A question we get all the time is, are rates coming down? They are. They've come down a little bit. Most rates are prime plus a buffer. And so prime might come down, continue to come down. But what it's not going to do, in my humble opinion, is go to where it was 3 years ago. 3 years ago, prime plus two was in the sevens. Now prime plus two is in the 11th. And that is not a number that will ever go back, in my opinion. You can't assume that. That's too aggressive. So after, we're going to ignore line of credit because line of credit is only something you use after closing to fund a receivable or, maybe fund a payroll when cash is a little tight, but it should not be a primary source of permanent capital. And then the next one is the seller note. And so the seller note is entirely negotiable with your seller, but we think it's a great source of capital just because it gives a seller a reason to care about your success. In boot camp, we talk a lot about should you personally guarantee a seller note or should you have it on full standby? Should you try to have an interest-only period? All sorts of things that are beyond the scope of the financial modeling webinar here. But long story short, all you have to do again is input your assumptions on the seller note. I would say seller notes should definitely be cheaper than your bank loan, without a doubt. Ideally, they have a standby period. Standby means you don't pay principal or interest payments. And the amortization should be as long as possible because that sort of spreads out the cash drain that a seller note takes out of your business. But look, that's all mechanical. The reason why I'm trying to share this tool is to say as follows. Right here in rows 56 through 60, we have pre-populated debt service coverage ratios for you because at the end of the day, when you go to the bank to have a conversation about the business you're trying to buy, the purchase price, and the capital structure just being your sources and uses, how you're going to fund it, They're ultimately going to be looking for, do you have enough buffer here? Does your business have more cash flow than your annual principal and interest payments? And DSCR, debt service coverage, is simply your cash flow or your EBITDA for a year divided by that same year's principal and interest payments. And we do it two ways. We calculate it with just the senior debt, which is your bank loan. And then we also calculate it including your seller debt, which is the primary way it's calculated. Now, some banks out there are willing to exclude the seller note from DSCR if it's on standby for a few years, which is kind of like the bank saying that they're treating it like equity. But that's not always the case, and that's bank by bank. So we typically assume DSCR2 is the relevant test. So when I say DSCR, let's think about what this means. This means, for example, in a 1.45 DSCR threshold, that means if you have $1 of principal and interest payments per year, you have to have $1.45 of cash flow. Or maybe a better way to think about it is if you have $1,450,000 of EBITDA a year, you can service up to $1 million of annual principal and interest payments. And so what we've done then is created this formula that says it spits out an oh no. It's kind of like a hey, warning. If you don't meet the threshold of 1.45, well, then it doesn't work. And so, one of the really great outputs of a model is to say, hey, I've got all these oh no's. The bank won't underwrite this deal. How do I make it better? Well, one way to do that is to go to a different bank. And I laugh because that's not a great answer, but like all you have to do is go to a bank. I laugh because this probably doesn't exist. Go to a bank that all they require is a 1.2 or a 1.1 DSCR, which means they don't require much buffer. You barely have to exceed your principal and interest payments in order to make this work for them to lend on it. Well, that's not a great way to actually go about, getting a conservative acquisition financed. So let's assume, I don't know, 1.3 of DSCR. Well, here it's saying it's not working. Oh no, our DSCR is less than one in years 3, 4, 5, 6, and 7, which is really to say in those years, your debt service requirements of principal and interest to the bank and the seller note are more than your annual cash flow left over after you pay the IRS. So that obviously doesn't work. So how do we fix it? Well, as you can tell, the reason it's saying, oh no, in those years is because those are the same years your seller note is being amortized. In the 2 years you're on standby, you're fine. But as soon as you go to paying down interest and principal on your seller note, it's not working. So, a great way to do this would be just extend out the time period. If you have to pay $500,000 in total, sorry, 1.5 million, the way to have your annual cash burden be less is to spread out the number of years you pay it. So let's change it from 5 to 8. Well, 5 to 8 helped a little bit, but it didn't help enough. I'll just toggle out of that change and you'll see here in this row, DSCR improved, it went up, but it didn't go up high enough to help. So we've got to do something else. Well, you can't really, the rate's not going to make a huge difference. So we see this all the time. A searcher will take a deal to the bank that looks just like this. And the bank will say, hey, searcher, your DSCR, our minimum is 1.3, and I see years where it's just barely 1.0. That it doesn't cash flow, it doesn't pencil. So how else can we make that work? Well, we can make that work a few ways. And this is to the primary benefit of your financial model. One principal way to make it work, and we're kind of laughing here, is to lower the price. So maybe $5 million was the asking price, but a great way to make this deal pencil is to lower the price. So 4.5 million is what I typed in. Well, nope, we're still at oh no, doesn't work. Maybe 4 million would work. Let's go back down. It did in the last 2 years. That's interesting, but it didn't work enough. So let's bring that back to 4.5 million, not all the way to 5. So lowering the price itself did not solve the equation for how to make it interesting to the bank. How else can we do this? Well, another way is to, and this is kind of universal, less debt, more equity. So in this case, we have on a $4.8 million project cost, we're using $4 million of total debt. And that's 83.3% of the project cost is debt. That's a lot of debt. So maybe what we decide to do is to raise a lot more money from investors. So if we go from raising 800,000 to 1.5 million, all of a sudden we're going to bring our bank loan down. That's what changed, is your bank loan went from 2.65 million to 1.95 million. It went down $700,000, the exact amount you increased your equity. Well, here we go. All of a sudden, because you have less bank loan, which means here in rows 26 through 28, you're going to have less debt service on your bank loan. All of a sudden, your DSCR is going to look a lot better. We went from barely 1.0 all the way to almost 1.3 in all of your years. So that's always an answer. So then most people say, great, now I've got two out of my three parties who I have to interact with. They're happy. Your seller is happy because your seller's getting $4.5 million, which was a little less than asking price of 5 million, but they're still getting 4.5 times EBITDA, which is a really good multiple on a lot of the businesses we see searchers buy. And your bank is happy because your DSCR is, let's just assume 1.25. We'll just make this clean. All of a sudden it works. Your bank is happy. Your seller is happy. Who's the last group you need to worry about that they're happy? Your investors. And so here's where you have this ownership calc. And so long story short, just to try and catch up a little bit and leave room for Q&A, your investors are going to look at this output, and unfortunately, they're not going to be super thrilled. And the reason is their IRR is showing 12%, and their MOIC, which is just a multiple of the cash they invested, is 1.9. Both of those things are too low. And look, like there is no true market for this, but I think what I would suggest is that IRR should at least be 30% and MOIC should be at least 3 to 5 times. And that's in a case where you're using very conservative assumptions around growth and margins. Okay, so we're back in a pickle. Our seller's happy, our bank's happy, but our investors are not happy. So we need to find a way to make that work better. So there's a few ways to do it. Again, tried and true methods of paying less for the business will always work. So look at this right here in cells K, 8, and 9. 12% return, 1.9 times MOIC. If all we do is we bring the price down, right off the bat, it's going to make the returns look better. Because all of a sudden, you had to inject less capital into the deal, less that goes to the bank, more that goes to the investors. Another way to make it look great is to to lower the amount of equity that goes into the deal. So the less equity dollars that are put into the business, potentially the higher the returns. It's a little dangerous because of the debt, but it's potentially higher returns to equity. So here we are, investor IRR and MOIC, 17.5 and 2.4. If we were to bring the equity from 1.5 to 1, 1.5 million to 1 million, that really didn't change much. That's interesting. I wonder why that is. So, and your bank is relatively happy. So what if we brought it down to say 750? So that doesn't move the needle a ton. And your bank is starting to get unhappy. So let's go back to 1 million of equity. The final way, the final kind of very meaningfully impactful way to change your equity returns is to change the step up. So in this case right here, where there's $1 million of total equity, what it's saying is you using $1 million of equity injected and a 2.5 times step up. The investors as a group would own 58% of the business and the searcher would own 42%. So that is, let's say we were to raise it to 3.5 times. Well, now our returns are looking better to investors, but look what we own. We, the searcher, only own 19% of that business. So that's obviously not going to work for us, the searcher. So, Chandler, we're trying to come back kind of full circle here. This is a tool as you're getting to LOI to really try and make sure that all four groups of people that are going to be involved in your transaction are happy. Your seller is getting the price that they want. Your lender is getting the DSCR that they want down here. Your equity investors are getting the returns they want. And last, but maybe most importantly, you, the searcher, are going to own enough of your business for it to be worth it to you. And obviously, this doesn't look great. And I'll kind of quickly shift to back to that business we looked at the sim earlier. What that deal actually looked like was as follows. It was more like this. $3 million purchase price. And I think the takeaway there is 3 times EBITDA is a price where the model will always work. 4 times EBITDA, the price starts to look tough. 5 times EBITDA, and it will almost never pencil. So we had something like a 20% seller note, and we raised a lot less money. These are all just close, not exact. And so obviously here we are. In this example, the bank is very happy. Your seller, so long as they'll take the price, they're happy. Your investors are very happy. And the searcher only owns 47%, so that's just right here, 2.5. And there we go. You're happy because you own a majority of the business now.
Love it. Sam, anything else you wanted to cover, or you want to start hammering out some questions?
Yeah, well, I'll say everybody, thanks for tagging along
Yeah, that
with
was
me.
fantastic.
This is an exercise that's better done over 3 hours
Yeah,
with a live deal, but we're trying to just give you a taste of it. And obviously at boot camp, we cover a lot more on financial modeling. But
yeah.
Chandler, if you want to take some questions.
Yeah, so the best way, I'm looking at the question and answer tab here, a lot of the same flavor of questions. So I'm going to do my best to combine the multiple ones into just general themes. Number one, so when we're looking at this investor IRR, that is pre-tax, correct or no?
So it's post income tax, but it's pre-tax to them,
Exactly.
pre-tax return to the
And
investor.
that is, and I know Can you explain what the reason why we do that? Is it because it's impossible to model every scenario, individuals' tax rates, or just
Um,
common practice?
well, I mean, we always take either entity level tax or pass-through tax distributions out because they are absolutely mandatory.
Hmm.
Um, you have to make them. There's no choice.
Yeah,
The reason that we do this pre-tax, I think, is because generally every investor has their own tax rate, their own marginal tax rate based on their own personal situation. So usually the question though that when we go down this line of thought that's coming up is the question, do tax distributions count as a return of capital? And the answer is yes, they do. Tax distributions to investors count in the return calculations.
awesome.
To be clear,
Um,
our partner and colleague at SMB Law Group, Laura, who's our tax lawyer, she does a lot of this kind of work, and she always reminds me to note that your operating agreement has to say as much. That's not done by default. So
gotcha.
sure you have a lawyer drafting.
Perfect. Another common question that we got, is there any rules of thumb of the level of excess cash flow you like to see in a deal? Is that X numbers of operating expenses? Is a percentage of the total project cost? Can you talk a little bit more about that?
Yeah, it's a good question. So I think the good news is your bank's going to help you analyze working capital. And it frankly, like excess cash as a percent of revenue or a percent of purchase price isn't super relevant because you could have two similarly sized revenues or transaction amounts and totally separate cash needs. For example, I'm in the fencing business and we have high working capital needs, lots of receivables. And so I need to be able to fund the business while we wait for receivables to come in. So I need a lot of excess cash at any given time. Um, I'd say like, 10, 20% of revenue or 2 months operating costs are what I would like to see. On the flip side, you might see a business like a residential HVAC business where, the customer swipes their credit card when you leave their driveway. There are no receivables. And so you need a lot less excess cash because, your customers are funding your operations every day.
Yep.
Good question.
Uh, Another question. Some folks are asking about rolled equity by owners. I guess before we even talk about modeling that, you just want to give a quick, like, your thoughts on it.
Yeah, look, I have been a fan of rolled equity because anything you can do to align the interests with your seller is a pro. I think it's complicated in SMB deals because at a certain point, you know, I- I've seen most of the time that at a certain point you want the seller to exit and not be involved. So to the extent you can get a seller note over rolled equity, I would prefer that as an investor. Now, as far as modeling goes, let's be clear, it's a lot simpler. It's not rolled equity the way that a lot of us think about rolled equity. When a seller has equity in the business after closing, it's simply that you're not going to buy 100% from them. So we have not yet modeled equity rollover situation, but it's not a bad idea. It simply would be the case that you and your ownership group are not buying 100% of the business. You're buying 90% and the seller's retaining 10%.
Perfect. Um, let's see.
And just so we're clear too, um, well, let's talk about that another time. That's a can of worms.
Yeah. So another one too, kind of, it might be in the same vein as a can of worms, but some folks are asking about contingent seller notes and really how to model that.
Yeah.
I would say if you're banking on a note like triggering the contingency and it going away for your deal to work, you don't have a deal on your hands,
Yeah,
which is
so
why we don't model it.
yeah, that's probably a fair point. We when I am wearing my investor hat and I get an opportunity from a searcher to invest in their business, What I like to see is actually three versions of a model. I love to see kind of like copy and paste this each tab three times and say like a best case, high growth, high margins. That's great. But I also like to see a worst case, which is something like revenue dropping by 40% or 30%, margins getting degraded. And in that downside case is where you can actually hard code in some triggers on a forgivable seller note. I've done a forgivable seller note on deals in the past, um, but I've tended to tie them not to like a headline revenue number. I've tended to tie them to like customer concentration or revenue by customer. So that's tougher to model than if you just had your forgivable seller note tied to something like revenue or EBITDA or gross margin. But we can do that another time.
Perfect. And then I guess in closing here, kind of one last question to some folks have been asking about it to clarify.
Mhm.
The tax distributions do count against um, preferred and capital return.
Yep.
Um,
Yep.
okay,
So tax distributions are simply payments of cash to your investors when your company is a pass-through entity. Because what's going to happen is in a pass-through, the entity itself, the business doesn't pay federal income tax to the IRS. What it does is it issues K-1s to all the investors, all the owners. The owners then take those K-1s and put that income on their personal tax return and pay tax on it. And so you can imagine if I own 10% of a business that did 1 million of EBITDA, my K-1 that I get from the company is going to say $100,000 of income to me. And I put that on my personal return and I have to pay tax to the IRS based on my ownership in the business. So that's why most operating agreements say in that scenario, the company has to pay investors cash so they can turn around and pay it to the IRS. So that's why we make those tax distribution payments actual returns of capital because they are getting paid out. What's maybe a more like easy to understand example is instead of tax distributions, this just said tax payment to IRS, right? Imagine the company were a C corporation where the company itself paid the tax. And then it's irrelevant to returns because that payment isn't going to the investors. That payment's going straight to the IRS.
gotcha.
That's a definite nuance. We cover that a ton in boot camp. This concept of taxable income, tax distributions is a confusing one. It's best done in connection with entity selection and tax elections. But the reason we have it here in the model is because for gosh, 5 years, people were modeling out and overstating their cash flow because they were forgetting or ignoring the fact that taxes have to get paid.
Yep. Um, and just one final clarifying question on that. So, do the tax distributions actually reduce principal? That is the key question. That was from Mike, SMB
Tax
Camp alumni.
distributions, yes, they count as so long as your operating agreement says that
Yeah.
tax distributions are normal distributions, then yes, they count as return of pref and a return of capital.
Yep. Exactly.
Yep,
That's the kicker there. Yep.
yep, yep. I should bring Laura in here next time. She can all set us straight.
Yeah, I know. So long story short, use the SMB
Hire,
law group.
hire good legal.
Yeah, exactly. Well, Sam, we're at time here. Or any closing remarks or comments, anyone on the group? I guess just some housekeeping stuff. Everyone that attended, as well as those folks who are watching the recording, um, everyone is going to get this recording. They're going to get this model, and they're going to get our slide deck here. Check that out in your email. If you don't see it by tomorrow morning, check your spam. Um, and other than that, like to Sam's point, one last thing, Sam. We do have a upcoming boot camp here in Tampa, our SM Boot Camp Live, where we go way deeper than what we could cram in an hour long webinar here on Zoom. all nuances of financial modeling. You get to hear from folks like Laura, who Sam alluded to in the SMB Law Group, as well as the rest of our deal team, who live, eat, and breathe this stuff and would love to come see you and help you out with your deals. Sam, any final words from you?
No, thanks for hanging out. And maybe one more thing is just a note that, again, we're going to do 6 of these to round out the year just because we've seen a lot of requests for this information in the public domain. So our next one's going to be Thursday, October 24th. We're going to go through a letter of intent on a live deal and really try and get people in a position if maybe they're not comfortable to submit an LOI on their own the first time, but maybe on the second time or third time, because once you get comfortable with all the terms in an LOI, it's a lot easier to be very active as a searcher and be submitting offers. So we're hopefully going to get people there. We'll see you on the 24th.
Awesome. Thank you, everyone, for attending. Be on the lookout for that email. Sam, thanks for a great session. We'll talk to everyone soon.
Thanks, Chandler. See you guys.
See y'all.